strategies. This is our last lecture. It summarizes throughout the investment classes and throughout the investment approaches different ways to buy and possibly sell the market. This is not strictly about portfolio management. Portfolio management is a little bit different. This is how you buy, when to buy, why you buy. In other words, if you're an investor like Warren Buffett, you use, for example, the value strategy. Alright, I'm going to be getting all of these one by one. We got 10 investment strategies. I've written another one, 11, which is also commonly used. So first we begin with so-called value investing. And it's also known as value investing strategy. It's very simple. You want to buy good value. You try to identify an undervalued asset and you expect that the asset will be in stronger demand, that demand will outpace supply. You expect that the asset will outperform other classes or will just perform really well based on its own fundamentals. You also, if you're a value investor, you also buy usually for the long run. For example, the strategy of James Dines, if you remember, he believed that uranium in 1999 was dirt cheap. The idea of value investing is that you buy something which is dirt cheap. But you don't buy it because it's dirt cheap. You buy it because he believes that oil is most likely peaking, or as many people already say, has already peaked in 2005. And he believes that the world will continue to grow. There will be steady demand for energy. And the next best thing to oil that humans know and works well in a large-scale application, because wind doesn't work on a large scale, it just works on a very small scale, is nuclear. And if it's going to be nuclear, you got to feed the beast. You got to get uranium. So uranium for the long run, the next 10, 20, maybe 30 years, according to James Dines, represents excellent value. Alright? Another value investor is Warren Buffett. He likes to use value investing strategy. This is what he has been using this strategy for all of his career effectively. What's his name? Warren Buffett. Warren Buffett. You should know him. If you don't, you shouldn't be here. Warren Buffett is what they call the greatest investor of all time. Well, that's how Wall Street tells you. I tell you, Richard Russell will be the greatest investor of all time. I mean, you listen to the one, listen to the other. You judge for yourself, but ideally you should know and understand both if you're especially in the investment business. Value is what Jim Poplava likes a lot. He uses mostly in value. He's been saying over and over, he uses at least 100 times. In a couple of weeks he uses 100 times value. This is good value, that's good value. And he tries to use fundamental analysis. So almost always value investing is based, when you make value based on fundamental analysis. So you use some sort of fundamental analysis and you identify the trends not based on technical analysis but based on demand and supply. Question? Yes, Peter Schiff is a value investor. He likes to look and see what represents good value. One of the ways to identify value in general is, and I'm now switching to specifically to stocks, is the price-earnings ratio. When the earnings are done well, meaning you have a fairly steady trend, you're using proper 12-month or 24-month trailing earnings, not forward earnings, which Wall Street usually inflates. Use actually what we call trailing or historic earnings. And the price earnings is relatively low. then the stock is considered to be representing relatively good value. Now, the main idea is that if the asset is undervalued, it may not get back to its proper market value tomorrow or the day after tomorrow. A lot of times it won't even get back to its good market value even 1 year from now. Sometimes you may have to wait 3, 5, 7, or even more years for the market to recognize the true, genuine, underlying value of that particular investment. Question?
Does it use behavioral analysis too?
No, you don't know. So who? We're not discussing now who uses what. We're discussing what the strategy is. So this value investing uses only fundamental analysis. It is based on fundamental analysis. Now, you have 10, 11 strategies. A lot of times, and I'll be explaining this at the end, some investor may use 3, 4, 5, or 6 strategies at the same time. In other words, most of the strategies are compatible. You could use 1, 3, and 4. They don't conflict each other, and they can all provide you the same signal or the same investment approach or the same type of investments. So they don't conflict each other. Some of them conflict each other, all right? So it depends again on what we call the investment philosophy. So investors will always have an investment philosophy. The investment philosophy will include the worldview of the different asset classes. For example, Peter Schiff's view is that dollar is going down, gold is going up, most stocks will be underperforming, bonds are a terrible investment. So this is an investment view. This is where do you see that the investment class or the asset class is going up or down, and understand why. And then you have an investment philosophy. And the investment philosophy is which particular strategies you use. Well, you may use some strategies more than the others, not because these strategies are better, but because you are better in those strategies. You had a good teacher, you had a good book, you had better or different experience, so you understand them better than the other market participants. In other words, you have a competitive advantage using these particular investment strategies. Is that kind of answering? Well, it's not, because I'm not trying to answer your question. I'm trying to just cover the strategies the way they are. Number 2 is straightforward. Dividend investing strategy. Alright, so Peter Schiff is a renowned dividend investor. He wants to see the real thing. The real thing. He wants to see cash. Accountants are paid to fake the accounting earnings. They play games with earnings. They play what we call accounting shenanigans, and in 2001 too, you had the so-called accounting scandals. There are 1,001 ways to play accounting games. There is no way to play games with cash. You either have it or you don't. When you provide the dividend check, it either clears or it doesn't. All right? You can't play games with dividends. So dividends are real, while accounting profits may be phony. All right? So many investors just say, I don't trust earnings. Earnings could be bogus. They could be subject to, let's say, accounting methodology, FIFO versus LIFO, amortization and depreciation methods. They use, for example, lots of games and tricks where they get the goods, they can't sell them, but they put it on the truck, they move it out of the warehouse, and according to the accounting GAAP standards, if you move the goods out of the warehouse, they are considered sold. If If they're considered sold, you book the revenue. Once you book the revenue, you subtract the cost of goods sold, you get the earnings, the accounting earnings. So this is cheapest and the simplest method to inflate earnings. Well, there is no way to inflate dividends. Quarter after quarter after quarter after quarter. The only really important thing to watch out in a dividend investing strategy is to make double and triple sure that the company is number one, generating the cash, so you watch the cash flow statement, and more importantly, that the company is not borrowing and leveraging up in order to pay the cash dividend. In other words, the company might not be actually generating real cash and real cash flow, but it may want to fool investors by paying out dividends, and it is doing so by borrowing money and leveraging up the balance sheet. In other words, it borrows more and it uses the proceeds from borrowing and loans to pay out the cash dividend. Also, if a company uses cash dividends and then switches to some other type of dividend, that's a big red flag. You gotta study long and hard, and the general principle of investing is shoot first, ask questions later, you know? Have you seen this in Western Hollywood movies?
No, what is it?
Oh, I forgot we're in Saudi Arabia. You can't watch Western movies. You know, you see the stranger, something's going on. The first thing you do, you always shoot the guy, then you ask the questions. You know, you can't afford, you know, to ask the questions that, you know, get killed in the process. So here, the idea in investing is simple. You first sell the stock, you make sure you're out of it, you make sure you don't run the risk, you investigate, you do your thing. It could take you a day, it could take you 2 or 4 months, and when you know, that meaning you have reassured yourself that the stock is sold, you buy back into it. Alright?
In addition to this, there are loyal companies, they're investors.
They're what?
Loyal.
Loyal.
Well, investors, even with the current prices, they still pay dividends.
Well, that's where the problem is. They may be loyal, but the point is you don't want to get fooled by loyalty. You don't want to get fooled by loyalty. Just because they're paying the dividend, you gotta figure out where the cash is coming from. It is a genuine economic operation.
I mean loyal even within the credit prices or any prices.
So what does it mean loyal? What has got to do with dividend investing? I have no idea.
They still keep paying out cash to the investors.
Yes, they keep paying out cash. That's what I've been saying. This means that the company is good and solid if it is not borrowing in order to pay out the cash. Right. This means that the business is solid and the business is healthy. If it's borrowing to pay out the cash, the company is suspect and the dividend is not, dividend investing strategy is not justified at that moment. Question?
Most companies use leverage.
Yeah, they use leverage. I never said the companies don't use leverage. They use leverage, meaning they use certain amount of debt to make their operations. But if they have to increase the amount of debt to pay the dividend, then something's fundamentally wrong. Alright? That's the key. Of course they use debt. The question is, do they increase the debt in order to use the cash for dividend payments?
Increase their obligations.
Yeah, well, yeah, that's the most important thing to watch out during or for dividend investing. Number 3 is contrarian investing.
Is it when you see the people are buying, you sell?
Yes, this is when you see that all the people are buying, like everyone's crazy to buy real estate in Riyadh and Medina. the best time to sell, all right? When everyone is buying oil, like for example, last year when oil was running up to 120, 130, 140, number one, you watch it every day, CNN, BBC, the news begins with oil ended up today $123. That's, the oil is hot. When oil is hot, you want to be out of it. Leave it to the suckers, all right? Leave it to the masses. Right now, oil has been going from $38 all the way to $72.5, $73, almost 100%. This is a phenomenal return, and you should know, not guess. You should know. CNN, no word. I never heard for the last 10 or 15 days, oil's been steadily rising, almost 100%. CNN, no word about oil. Oil does not exist on CNN. BBC, no word on BBC. It is just moving slowly but steadily, quietly out of the sight of the media. Now, no one is paying attention to oil. Well, when they're not paying attention to oil, this is a great buy. That's when you want to buy. I mean, how many of you're 2, 4, 6, 8, 10, 13, how many of you are invested in uranium or have good friends, know someone who has invested in uranium? You?
Not uranium, oil.
No. I'm asking about uranium. Uranium. How many? Nobody. I know one. I know James Dines is investing. So, uranium, no one's invested in it. It's a great investment. Here's another example of a great investment. Last year, a year and a half ago, when I was in Bulgaria, I went to the local investment broker, and open an account and whatnot. And I asked him, "Hey guys, I want to buy gold." They say, "We don't know if we sell gold." I said, "What do you mean you don't know?" "Well, you're the first one ever in the history of this office walking in asking about gold." I said, "Okay, but what about oil?" "We don't know." I said, what do you don't know?" You're the first one asking about oil either." "Okay, I said, okay, the price of bread has gone up twice, almost 3 times. Everybody eats bread. What about buying wheat?" They said, "But you're asking about commodities. We don't know anything about commodities." This is the year of 2008. Well, in 2008, the Bulgarian investor has no idea about investing in gold, oil, or commodities, all right? I mean, how many you have big investors in wheat, just buying wheat, the thing which we make bread? How many?
I don't know.
Nobody. Well, now you know. If you're a true, genuine contrarian, wheat is still a great investment, all right? Not real estate in Medina, all right?
Jim Poplava said that.
Sorry, so Jim Poplava is a great example of a contrarian investor. All 4 people on the audio show that we had the round table, Richard, Russell, and Peter Iliadis and whatnot, these guys are all contrarian investors. James Dines' fundamental approach, main strategy was he wants to buy something that everybody hates, that everybody doesn't know about. Peter Schiff is also using contrarian investing. Look guys, no more talk. Otherwise you're going to earn a penalty point. You keep arguing, we'll double the penalty. Alright, let's see.
On the round table, Peter
Iliadis.
Yes.
Okay, what about him?
On gold, he was short selling on gold.
Well, he was short selling because he was just, you got to understand that some of these guys are also professional traders. If they're professional traders, they have what is called a core position. In your core investment position, you buy and you hold it for the long run. And they have a trading position. in your trading position, you will be buying and selling and maybe trying to time the market. And if it goes up a lot, you sell. When it goes down, you buy. When I was trading in the late 90s and especially in the early 2000s, I had two separate portfolios. I had 90% of my portfolio was long-term investments. One of them was my house. Then I had back then lots of gold, lots of silver. This was my long-term investment. I didn't touch them. Buy them, put them away, and as Richard Russell says, and you forget about them. Then I had a trading account where I was using mostly futures, options on futures, and I used futures for currencies, for oil, mostly gold and silver, alright? And there I'm trying to time the market, I'm buying, selling, I'm doing technical analysis, and I've been struggling for 6, 7, 8 years. It's actually extremely difficult. It's extremely difficult. A lot of times you wake up at night at 4 o'clock in the morning to watch and see how the market trades during the night. A lot of times you lose sleep. Very often you are under severe stress. A lot of times you build up your portfolio, means you add slow, steady profits, meaning trading gains, and over time you're able, because you're running with huge leverage, you add up, you can increase your portfolio 2, 3, 4, 5 times, and then in 3 days, wham, you lose 90% of what you've made over the last 3 months. Or during 2004, when I had built up my portfolio to almost $100,000, I lost most of it. It had to take me a year to recover the losses which I incurred over the period of 2 or 3 days. Alright, this is what Nassim Taleb will call that I experienced a black swan. Whatever you made in a long period of time, you lose in a matter of weeks or a matter of days. You experience an extreme event, extreme in my case, trading event. Alright? So, contrarian investors, actually all of the great investors, including Warren Buffett, uses contrarian investing. There is no road to successful investing unless you are contrarian. All the great guys have always been contrarians, have understood contrarian strategy. Now, contrarian investing is based on behavioral finance and uses what we call market sentiment. You want to gauge market sentiment. And this is what they were talking about during the audios, that you use market psychology. So whether we say market psychology, market sentiment, this is the same as what we call here behavioral analysis. So you try to gauge the sentiment. You watch mainstream media never to learn. The only reason you watch BBC, CNN, and CNBC Arabia, right? Yeah. You always watch it so that you can gauge investor sentiment. Once they start talking a lot about something, it's time to begin, gauging, using some sort of technical analysis to get out of it. Doesn't mean you sell today. It may run for a while, but you begin seriously thinking of what they are not talking about, so that when you sell, you're going to be able to reinvest already into something. Question?
Sorry, sir. So basically, about contrarian investing, if you want to define it in brief,
So the contrarian investor or contrarian investing strategy is the strategy where the investor chooses to invest in what majority of investors are not invested in, and the investor sells when majority of investors are already invested. In other words, when you have a strong bullish sentiment, that's the time to sell. In other words, when it's blood on the streets and everyone is fearful, that's the time to buy. Alright? When everyone is jumping to invest, that's the time to sell. as I've been explaining before, and students eagerly argue, and they are just explaining to me, how stupid the strategy is. The great investment today, as in last year, is real estate in Iraq, real estate in Baghdad, right? Is it a good investment? It's a war zone, they tell me. Don't you know, professor? Are you stupid? It's a war. Well, that's what makes real estate dirt cheap. No one is buying real estate in Baghdad. No one is investing. There is still some selling because they just say, I want to get the hell out of hell, right? I just want to get the hell out of here. I'll sell it for $5,000. Then they say, but there is a phenomenal risk. There is a phenomenal risk. They can just blow up your house, in a war zone, the house can get blown. Well, then you use the strategy called diversification. You buy 10 houses at $5,000 each. So for $50,000, get 10 houses in 10 different neighborhoods. 3 of them can get blown up and you lose everything on them. On the other 7, you're going to make your money 5 times because the war most likely will be over. I mean, this is not going to be a war that will last for 20, 50, or 150 years. Sooner or later, the war will be over.
And the real estate prices are going
and real estate prices will recover because Iraq still's got the oil there.
That's right.
All right, another great example when to buy real estate is, and I'm amazed, Saudis are rushing like crazy today to buy real estate in Beirut, right? Oh, sorry, Lebanon, Beirut, right?
Yeah.
Why? You want to buy right after the war. What is it, 2006? That's where people are panicking. That's where real estate is dirt cheap.
Now
That's
it's good
where
to sell. Now it's good to sell.
Now it's good to sell to all those Saudis who are going like crazy to buy there, right?
It's good to sell.
Now it's good to
Especially
sell.
after the elections.
Yeah, especially after especially. But the point is, this is how contrarian investors think. The war over there in 2006, you go and buy it dirt cheap. War right now. Now, which is the country with the biggest economic devastation over the last year? Economically, the most devastated country has been Zimbabwe. Now, how many Saudis are investing now in Zimbabwe real estate? Zero. Then, this is a guarantee that the investment is perfect. That's what a true contrarian will do. Where all the Saudis are investing, stay out of it. Check and see where they're not investing, and that's the place to be in for the mid and possibly long term. Why? Because the economy has been completely devastated in Zimbabwe. It is dirt cheap. Again, a few $1,000s, $3,000, $5,000, $8,000, you can buy a little something. $10,000, $15,000, $20,000, you can buy big something, like a big house or whatnot, alright? The economy is going to recover. It won't stay forever. Again, even if it stays forever and you're a contrarian investor, you will diversify. Now is the perfect time to buy real estate in Iceland. Iceland has been economically devastated after the credit crunch, right? Real estate price fallen 60, 70, 80% already. Now, there is a hunger. The economy is starved for currency. Now is the time to go. So, the point is, you diversify your contrarian. You get some real estate in Baghdad. Yeah, it may work out, might not. You get some in Iceland. It might work out, might not. Probably it will because they have no problems. You get some in, let's say, Zimbabwe. Some of these will work more than enough to compensate you for some of the losses elsewhere. And just buy wheat. People will keep eating no matter what. Alright?
Defensive industry.
Well, defensive industry, maybe, maybe not. A lot of people are or have been investing in the defensive industry for the last 3, 5, or 8 years because you gotta feed the Iraq and Afghanistan war. But every stupid investor has already figured this one out. They've been investing since 2001 in defensive because they anticipated the Afghanistan war, they've anticipated already the Iraq war, they've been going on for a while. Every dumb investor in the world is already invested there. Now may be a great time to sell your defensive. You see? So this is how you try to gauge the market. If you really want to be or you want to stand the chance of doing great with your investments.
How do you invest in stocks?
In what?
Mean.
Well, there are a number of ways. ETF, exchange traded fund. It trades like a stock, usually the New York Stock Exchange, but they also have some others, and use ETF. Another way is someone will have a fund. There's going to be an investment fund that will be investing in the wheat, and they'll store it for you, and you'll be paying them, and you're going to be paying some storage fee. Similarly with oil, you can invest through an ETF. Now, you can invest in oil in the oil itself, which somebody stores for you the barrels. They're going to charge you $1, $2 of storage each year for actually keeping the oil somewhere stored for you. Or you can invest in the oil stocks. But when you invest in oil stocks, you have management risk, you have a whole bunch of other risks on top of the commodity risk itself. Alright, I don't want to get into that difference between gold and gold stocks, and oil and oil stocks, and I don't want between the commodity and commodity stocks themselves. Let's move on to 4, momentum investing strategy. Momentum investing strategy. Alright, let me pause here because I forgot an important thought. You may be a contrarian investor and it matches perfectly with value investing. In other words, you buy uranium, no one's investing in uranium, and you're actually getting a good value. Alright? Peter Schiff has been emphasizing he's a true contrarian, but he's saying, hey, he's a contrarian, but he wants to see real good value. He's looking at the price earnings. He wants to see the dividend too. So these 3 go along together really well. Many investors actually use all 3. Many will use more. Now, what is momentum investing? Momentum investing is the strategy that the investor uses when they identify a trend. They invest into the trend in the expectation that the trend will persist. This is some of the most sophisticated traders do it, and momentum investing is also the most primitive of all types of investing. For example, my father's been watching real estate prices in Bulgaria go up and up and up and up and up and up 10 times in a row. 97, 98, 99, 2000, all the way to 2007. In the most primitive form of extrapolation, if prices went up for 10 years in a row, they will go in the next, and the next, and the next. And after 10 years seeing it up, he concludes that real estate prices always go up, no matter what. Real estate prices never fall, like they never fall in Riyadh and Medina, right? This is the most primitive, the most naive form of investing. You always want to identify amongst your friends and relatives people like this, and you always play against them as a contrarian. So, usually my father is a great indicator because he's got difficulties with reading. So the only thing he does is watch TV. Watch TV. So, usually, I talk with him often. When he starts saying, hey, gold is making new highs, it's going back, that was many months ago. Gold is approaching $1,000. He's been quiet for 6 months. Suddenly he's talking about gold. The other day, we've been talking for many months now. The other day he said, well, they're saying on TV that oil is pushing above $70. I said, this will be an intermediate top, most likely. Of course, it can run for another week, 2 weeks, or 3 weeks, but Bulgarian media are beginning to talk about oil, all right? With local media. So apparently that's a strong indicator. So back to momentum investing. Well, what's Bulgarian media saying? What Bulgarian media is saying is that oil is strong again and that they should get back into it. Well, are these people stupid? Oil has already doubled. Oil has already given you, meaning given already 100%. But people in the most primitive form of thinking, they see it going up, they want to see it go up, they want to be sure that it's going up, and only after it's gone up for so long, only then they buy. Alright? So this is momentum. Well, with professional traders, they use mostly technical analysis. They use mostly technical analysis. They use some forms of sophisticated technical analysis where they try to identify the trend and jump on the trend and hope that they will be able to jump out before the others. Well, one thing we know for sure, that when all they jump into the market, they all will not be able to jump out. The first 2, 3, 5% will be able to jump out. The rest will get burned.
Go to the short term.
Yes, this is usually short-term investing. Yes, this is usually short-term. Very often, this is, let's write it out. Intermediate. Momentum investing is associated mostly with professional investors in the money management industry. Mutual fund managers, pension fund managers, they, in other words, sometimes big institutional investors, the big money, they want to see the trends established. For example, Jim Plaza's been talking in his latest audio that now major insurance companies are getting into gold. Well, now some major hedge funds are getting into gold, all right? So what we're talking about here is major institutional investors are just beginning to accept gold is a good investment, all right? Why? They are, in a sense, momentum investors. They're not smart investors. They're momentum investors. They've been watching gold rise for 9 consecutive years. And only then, being convinced that what they've been using for the last 10 or 20 years doesn't work anymore, and they look around and say, well, what else has been working? And the answer is gold and oil. Oh, and they jump on it. All right? That's momentum investing. Question?
You're talking about momentum when it goes up. What about when it goes down?
Similarly, when it goes down. When it goes down, momentum investors will go ahead and short. They will go ahead and short. All right? So, as oil went up to $140, it started moving down and down and down and down. This forced a lot of liquidations because people bought oil on margin because they thought that it was going to 200, 300, or 500 in the short term, so they margined into the market, and the market margined them out of the market because they couldn't meet their margin calls. So at that point, you had a massive amount of professional traders who used the downtrend momentum into the market and was setting short, 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 and they drove the price artificially down to 38. And I'm always like to tell the story was that when the price was $39, the day before the market bottom, and I was teaching here last semester MBA classes, MBA South students, and I asked, hey, what's going on with oil? Is it going up or down? And all of them, they told me it's going down. And I say, great. As a contrarian, I know this has got to be the bottom. Well, the next day was the bottom. So easy to call the market when you got a lot of people around you and they all agree on the direction of the market. And they all are collectively wrong. over and over again. When I get 30 students who don't have business degree yet and haven't completed their investment course yet, and they all know that oil is going down, they are all wrong at the same time. Now, you may get a lot of people to agree, but you get to agree, Richard Russell and Jim Plow, they're all contrarian. They all agree that, for example, gold is a good investment because they all see that no one else is investing in it. So you cannot judge, contrarian by watching at contrarians. By definition, no more than 1% of investors are contrarians. Question?
Are you suggesting that when oil goes down, that's the perfect time to buy? Of course. Of course.
Of course. See how? Are you suggesting that when oil is going down, of course that's when you buy. When you buy, when the price is low. No, I didn't say low west. You can never know until the exact day of when the market is lowest. That's what I've been explaining for 4 weeks in technical analysis. Technicians read hundreds of books, use extremely powerful software to identify the bottom, and they get it very often wrong. There is no perfect formula. But you judge. You use some fundamental analysis. You just know, at least I know at 38 that oil in 2009, oil at 38 is dirt cheap. So it represents good value. I know that a lot of people are not invested, so it's underinvested, underowned. So I know as a contrarian that 20 Saudi students tell me oil is going nowhere but down. So I use the different types of analysis, and most of them are telling me, uh-oh, it's good time to buy. Right now at 72, my dad is saying, well, Gary and me are talking about oil going above 70. I say, uh-oh, it's time to sell. At least an intermediate sell. It's time to correct, get it back then to, let's say, to 55 or 60. Let a lot of people lose faith in it, and they say, well, it's over, and then it's the time to buy again. That's the contrarian. All right, let's move on to 5. And 5 is passive investing. So, alright guys, no more talk because you're going to earn yourself, penalties. Next time you get 2 penalties, alright? And, say goodbye to the A grade.
I was just telling him that one of my friends just invested at the 60.
What? At the 60. Well, you can't, you gotta first gauge how sophisticated the guy is. You gotta gauge some of his history. Is he always early? Is he always late? You gotta figure that guy out, alright? Alright, so what is the passive investment strategy? You do not try to analyze the market. Simply just buy and hold simply because the market is efficient. Let's put in here efficient. And if the market is efficient, you cannot beat it. If you can't beat it, you stay with it. So you buy some Dow Jones stocks, maybe some bonds, you put in 50% stocks, you put in 50% bonds, and you stay with them for the long term. There is no point to figure out the better stock, because if you're able to figure it out, then 1 million other investors are able to figure it out, and if they figured it out, they've already driven the price up. In other words, the market is efficient, you can't beat it, just buy the whole thing. So part of this passive investing, one special type of passive investing is called indexing. Indexing essentially means that you try to replicate a particular index, maybe the Dow Jones index, maybe the NASDAQ index, maybe the S&P index, maybe the commodity index, we call it the CRB index, maybe a bond index. So you, number one, passive is efficient, and you try to make an index. In other words, you use well-diversified portfolio, well-diversified.
Try to mimic a well-established index.
Right, and you try to mimic a well-established, in the sense of well-diversified index, and hang on to it, because there is no point. You're not doing any analysis. Most fund managers are passive investors, and most general non-professional investors are essentially passive, because they just invest their money in a big, well-diversified fund, and the well-diversified fund is not attempting to pick stocks.
So it's just for the long term?
Well, mostly it works for the long term, yes, mostly, because in passive investing, you know, or you accept that the market fluctuates up and down, you can't time it, there is no point in doing it, and if you're just going to be parking the money for 1 or 2 months, you might even suffer losses. So, unless it's going to be for the long term, you don't want to be a passive investor. If you're going to be for the short term, you're just going to put it in a savings account. If you accept that the market is efficient, you're going to be using a well-diversified portfolio.
No one from our analysts are
Yes,
passive.
of course. No one has become rich with passive investing. Why? Because the best you're going to get is the return in the market, which is modest. 6% maybe after inflation. You're going to be getting a 10% return. Alright? Gold's been given 16-20% return in the last 9 years. Gold has beat the market, stock market, how many times? Well, the ratio was, if you guys remember, 40-to-1. Dow to gold ratio was 40-to-1 at 2000. Right now, Dow to gold ratio is 7 or 8. So, gold has outperformed Dow Jones 5 times. In other words, with a good investment strategy, you beat the stock market 5 times. This is the next, which we call active investing. Active. So, in an active investing or in investment strategy, you try to perform some type of analysis. Could be behavioral, could be fundamental analysis, maybe, let's say, technical analysis, but you try to pick your investment, possibly even time it, but that's a different strategy. For example, all the investors that we mentioned are all active investors. They all choose intentionally some areas like gold and oil for whatever their reasons are, and they very intentionally avoid the bond market. They get their own reasons. Most common reason is that the actual inflation is significantly higher than the reported by the government inflation, right? The governmentally reported inflation. So they believe that real returns on bonds are negative, and that this is a sure way to lose the money. This is a sure money-losing investment. So they stay out of it, all right? They use their form of analysis, whatever it is, but you try to make it big. Active investor, of course, James Dines. He selects uranium for whatever his reasons are. You listen to his audio to find out, or read his bulletin, or whatever, but he's got his good reason. I'm an active investor. I select my own investments, mostly gold, mostly silver, for whatever my reasons are. You know, I read thousands of articles on those. I try to understand. I teach money, I teach history of money, teach money and banking. So, trying to understand money and banking for whatever my reasons are, I actively select gold and silver. Also, all the other guys, the whole round table, they are all active investors. Peter Schiff is an active investor. Everyone that we have studied is clearly an active investor.
Does it use a lot of psychological analysis?
Yes, some of them use cyclical analysis. So with active investing, you use, that's this, some type of analysis. Some use behavioral, other use cyclical, other use technical, other use fundamental. All of the great guys that we have studied so far, they use all 5 types of analysis all the time, simultaneously. You can't get a great investor with one type of analysis to invest right and well. Alright? Usually, all the great investors use all 5 at the same time. With one only, you can't make it work most of the time. Alright? You can't make it work even half the time. You gotta use the all 5. All 5's gotta be giving you the idea of buy or sell, and then you act on it. Alright? And this is what active investing is all about. The next strategy is called number 7, defensive. Now, defensive strategies got 2 different versions and definitions. The textbook classic definition of a defensive strategy is that you invest in defensive stocks and defensive investments when you perceive macroeconomic risks. For example, the economy is going down, and if the economy is going down, you buy defensive stocks. So, what is a defensive stock? A defensive stock is a stock which outperforms the other stocks in a down or in a generally weak economy and in a generally weak market. We discussed those many weeks ago. For example, toothpaste. People will continue to use toothpaste whether in a boom or in a bust. Most of us guys that we actually shave, we use aftershave cream or balm, whatever, and these will continue to sell no matter what. Food is defensive. People will continue to eat and they won't cut down on their food just because the economy is in recession. They'll cut down on flat screen TVs, on maybe computer purchase, a luxury car purchase, but you know, if they like to eat, they're going to keep eating. Another defensive industry is financial is cyclical. The opposite of defensive is called the opposite. So I put in unequal sign. Doesn't mean it equal. It means opposite is cyclical.
Energy is defensive?
Energy is not defensive. In a weak economy, demand for energy falls significantly. The example over the last 6 or 8 months, as the global economy went into a global recession, demand for energy falls, and because demand is inelastic, price collapses significantly. Don't get fooled that because people need energy that it's defensive. Yes, they need it, but the question is, can they cut down? If business slows down and into a recession, most of the business transportation will go down or will shrink. But people's eating won't shrink.
That's right.
Another example that I meant to say is pharmaceuticals. Pills, as in drugs, as in medical, all right? If people have high blood pressure or sugar or whatever the pill they need to, take in order to survive recession, no recession, depression, you're going to keep buying the pill just to...
They might buy more in the recession because they might feel bad.
Yeah, they might feel bad, they might buy more, but that's a whole different story. The idea is that pharmaceuticals are defensive. Alright, here is the broader definition and understanding of defensive. Is when there are other general problems, for example, with the financial industry. Defensive will be considered gold, where the financial system is generally under threat. For example, AIG was blowing up and Lehman Brothers were blowing up. Everyone went into bonds. So bonds are considered in many ways to be defensive, especially government bonds, especially short-term government bonds, because they are not subject to inflation risk. Then a lot of investors shift from stocks into bonds or into gold. So gold is considered the ultimate defensive investment. The ultimate defensive investment. In times of extremely high inflation, this is the ultimate defensive. In times of extremely high deflation, it is the ultimate defensive play. In time of stagflation, it is the ultimate defensive play. So, when things are good, you don't invest in defensive stuff. When things are bad or going back, or you anticipate before others that things will be going bad, you switch into defensive. Now, defensive does not mean, it does not contradict value. A lot of defensive industries, defensive strategies will be also good value. A lot of defensive will be also dividend. In many ways, a lot of these investors, like Jim Plava says, you gotta go defensive. You gotta go defensive. Times are hard, the economy is going down, you got financial risk, you gotta stay defensive. Alright? So, defensive does not contradict. Actually, defensive is a very special type of an active strategy. Alright? A lot of people actually try to invest in defensive combining with momentum. When they see that defensive industries gain momentum, only then they switch out of cyclical and into defensive. So, a cyclical stock is a stock which outperforms during economic boom. And a defensive stock is a stock which outperforms in an economic bust.
None of our investors are using.
What is it?
None of our investors.
No, Jim.
Well, all of them in a different way and in a different form are defensive. For example, what does Peter Schiff say? Buy gold, you got inflation risks, all right? You got earnings risks, you got economics risks. Real estate market's blowing up, banks are blowing up, the economy is tanking, the dollar is tanking. Gold, he's not recommending gold because he's nuts or crazy or a gold bug. No, he's investing it because gold is the core position in a what we now call defensive portfolio. Defensive. So when in bad times, what we want to do is you construct a defensive portfolio. Well, what does constitute defensive portfolio? High dividend yielding stocks. In other words, in bad times, the company is still able to generate cash and pay out a dividend and a big chunk of gold. Now, whether it's 10, 20, 30% is a whole different story. For basic diversification, it is recommended 5 to 10% gold, even in good booming times. In weak times, you can increase your gold position up to 15%. In really terrible times, you might as well go up 20 or 30%. Alright? Again, depends how many or other defensive plays you have in your portfolio. If your portfolio is 90% defensive, then your gold doesn't have to be more than 20%. Alright? On the other hand, if you got nothing else that's defensive, you might increase your gold position to 40% to compensate for some non-defensive. Alright? Again, this is the general concept of portfolio theory, where you diversify and try to balance your portfolio in different ways, alright? So, defensive is also based on, let's add here 2 pieces. Number 1 is cyclical, because defensive is based on the business cycle. In other words, you gotta figure out the business cycle in order to invest appropriately in defensive or in cyclical. This is not a coincidence, it is a logical. It is a logical that based on the cycle, you invest in cyclical or defensive. Alright? Is that clear?
Yeah.
Move on. 8 is, let's raise Market timing is very straightforward. It is an investment strategy where the investor attempts to time the market and identify a local bottom and buy at or close to the bottom, and then identify a local top and try to sell at or close to the top. Alright, usually market timing, of course, is always an active investment strategy, and a lot of market timers combine it with momentum investing. And in market timing, you use mostly technical analysis, but you use market sentiment, you use market psychology, and you use in generally behavioral, mostly in a contrarian. So, most of the guys that we saw, Richard Russell and all the other guys on the audio, they are also market timers. They're also market timers. They try to time the market. Now, market timing sometimes is in conflict with long-term investing. Sometimes it is in conflict, but not necessarily. For example, you try to time the market to enter your position. So you say, okay, I'm gonna be buying uranium anyway. This is what James Dines was explaining. He said he figured out that uranium was a great investment. It had genuine value. It was a true value investment. It was a true contrarian play. And then he started watching it using technical analysis. He was watching the downtrend that had been established for over 20 or almost 20 years. And then when it broke above the downtrend and the downtrend was violated, he used again some contrarian behavioral, he used cyclical analysis, he used fundamental analysis, he used all types of analysis. He said, okay, now is the time to enter. So he timed the market, and he said he was pissed because he, entered within a few days. He couldn't get it down to the day. He wanted to time it on the day. All right. For example, I've been explaining over the last, let's say, 2 weeks or 3 weeks that I'm thinking of buying silver as a long-term investment that I intend to hold for 3, 4, 5, maybe more years. I don't know. I saw that short-term silver was up, so I am timing the market. The silver price peaked at 16. And I'm trying to get it down to around 14. And if it's getting close to 14 and I feel comfortable in the short term, I'm using a lot of technical analysis. In the short term, I'm trying to get it around 14. And in this particular case, market timing is used mostly for the entry point or mostly for the exit point in a long-term investment strategy. But a lot of traders are mostly market timers, all right? So you can use market timing in short-term or intermediate-term trading strategy or in a long-term investment strategy, all right? Remember, if it's just short-term or intermediate, we call it speculation and we call it trading. Most of this course that I've been talking mostly about long-term investing, simply because the course is on investing. Alright, is it clear? Alright. Let's see. Number 9 is called buy and hold. Buy and hold.
Passive?
Strategy.
Passive. Passive.
Well, not necessarily. Many investors are passive, but I am a buy and hold investor. I bought my silver a long time ago, bought in 2002, 2003. In 2009, I'm still holding on to it. Alright? I'm still holding on to it. So, buy and hold combines well with passive, but buy and hold combines well with active. Alright? So, buy and hold combines market timing, all right? So I use buy and hold, and I also use market timing, all defensive. How? I am heavily overweight gold and silver because I perceive too many macroeconomic risks and too many financial risks. Alright? So buy and hold is also used with value investing. Alright? So buy and hold combines with value. Buy and hold combines with dividend. Alright? Buy and hold combines with contrarian investing. Buy and hold may combine, but usually does not mix with momentum, because momentum investing is usually short-term, mostly intermediate type of investing. All right, you try to jump on the strategy. So it may not be. Buy and hold mixes with passive. It mixes with active. It can mix with defensive. How? For example, 1970s or over the last 7 or 8 years, you have extremely high inflation. You have extremely aggressive monetary policy, and you have very high inflation risk. So it jeopardizes stocks, it jeopardizes bonds. Real estate already went through a bubble. So you use buy and hold in combination with defensive, and you stay with gold, because there's nothing left to defend you but gold. Real estate is a very good, in other words, defensive in this particular case, it's kind of like a hedging strategy. So what I'm talking about is an inflation hedge. Real estate has always been a great inflation hedge, and people always choose real estate as a good inflation hedge. But after a bubble, real estate is a terrible inflation hedge. So after a bubble, the only meaningful inflation hedge is oil and gold. Alright? So that's buy and hold. Now, let's try to write out this. This is also known. It is the same, and there is no difference from long-term. Long-term investing or long-term investment strategy. So, as far as I'm concerned, people use buy and hold and long-term interchangeably, and there is no difference whatsoever. Some may find a difference, but in general, no difference. Question?
Peter Schiff uses buy and hold.
Yes, Peter Schiff uses buy and hold. He's clearly buy and hold. Jim Poplava is clearly buy and hold. I am also clearly buy and hold, although for 10% of my portfolio, during the late 90s and early 2000s, up until 2006, I had a 10% of my portfolio which was a trading. So 90% was buy and hold, long term, and 10%. So these you can mix. You can have an investment account, and separately a trading account. This is also part of diversification strategy, all right? So in other words, I use my long-term portfolio because I may get wiped out in my trading account, because I have paid 3 times in a row, but I don't give up, all right? I try to recover and whatnot. The idea is that my trading account gets wiped out, but my portfolio is not. 90% of my portfolio is still healthy. And on my long-term portfolio, I more than make up the losses of my trading account every now and then. Now, when I make a lot of gains on my trading account, I take half the gains and I shift them over to gold or some other defensive play, alright? So, when I suffer losses, I use income and earnings, meaning from salary and whatnot, to replenish my trading account. When I have huge gains, I take the gains and invest them in a long term, and I'll play with them, alright? That's just an example. So, long-term strategy. Alright, finally is asset allocation. Asset allocation strategy uses the approach that you choose based on investment analysis. Again, fundamental, technical, whatever analysis you use, but mostly fundamental. You choose the particular weights for each asset class in your portfolio. You first choose the asset allocation and then do the rest. In other words, I'm saying for myself, I'm going to be 0 weights in stocks. I'm going to be 0 weight in bonds. I'm going to be 40% weight in real estate. I'm going to be let's say 5% in currencies, cash. I'm going to be 55% in precious metals and commodities. And this is my asset allocation strategy. All right? Jim Poplava says his asset allocation is 20%, let's say, short-term bonds, government bonds, where it's just part cash. All right? Maybe 10% diversified currencies like Canadian dollar and Australian dollar and whatnot. Maybe 40% stocks, but based on active investing, commodity stocks, and other defensive like water stocks, energy stocks, blah, blah, blah. And then he says 30-40%, let's say, precious metals and the commodities themselves. So you first choose what's your asset allocation, and then you use either value or dividend. Well, you got to understand that usually you work the other way around. You usually base your asset allocation on value, on fundamental analysis. In other words, Peter Schiff did not just say, I'm going to use so much for stocks and so much for bonds. He used extensive fundamental analysis. He uses extensive value approach. He does valuation, and based on valuation, he designs an asset allocation strategy. All right? So sometimes this is leading, but sometimes this is a result of other investment approaches. You figure out what's the asset allocation and then move on. Now, there is a very interesting sentence. It's an amazing sentence in the textbook which clearly states that the asset allocation has been the key determinant to 90% of all returns of investments. In other words, whether you pick the right stocks wasn't important. All right? Whether you were staying in stocks wasn't as important. The only thing that determined the return on any portfolio was how you distributed your investment between stocks and bonds and possibly commodities. Getting the asset allocation right will guarantee you great profits or will guarantee you great losses. In other words, getting the asset allocation will determine 90% of your returns. For example, you choose to be 100% in commodities and nothing else. Whether you bought wheat or zinc or copper or gold or oil or natural gas, it will determine very, very little in overall. They all went up. All right? If you invested in bonds, whether invested in corporate bonds or whatever, if you were in the bonds, the mere fact that you invested in bonds will determine most of your investment, all right? So, if the asset allocation was the most important determinant in returns, this simply means that the whole portfolio theory, in a sense, is garbage, all right? All right, because it essentially means portfolio, because the stock market is always perfect and efficient at all times, everything priced correctly. But, if asset allocation beats clearly portfolio, the whole portfolio, or underperforms the portfolio, apparently you first got to use the asset allocation and then within the asset class diversify. Alright? So you get into commodities, then within commodities you diversify with a precious metal, with energy, and with food. For example, gold, wheat, and all that. Alright?
Asset allocation it has to do with any other investment strategy, because you have to have an asset allocation.
Well, that's where the point is. You simply have to have, because all the great investors do have, but most don't. You don't have to have. Most people invest blindly. They put in some stocks, they put in some bonds, that's the end of the story. Alright? Eventually, you will end up with some asset allocation, but for a lot of people, the asset allocation is not a conscious thing.
Or maybe they don't know about it.
Yes, they don't know about it. But more importantly, all investment advisors consider the asset allocation as a simple choice between stocks and bonds. And this is shockingly primitive. Well, they consider it for a simple reason. That's what they sell. All right? That's what they sell. They manufacture paper and then they sell it for your hard-earned cash.
That's a no books. That's all the no books.
Yeah, and this is exactly what your book is. But now, having studied Peter Schiff and Jim Puplau and Richard Russell and James Dines and all the great names that with it, you know better than that. All right? That's standard. Now let's add another one, which I kind of added down the road. It's not a, let me explain it. This is because Jim Puplau has been talking about it over the last 7 or 8 years. This is what we call steady accumulation. And he's been saying over and over and over again that you just average into the market. To average into the market, as he's been explaining it over and over, you put in some basic core position and then every month you buy. The price is up, you buy. The next month the price is down, you buy. The next time. Now when you accumulate steadily at the end of every month or at the beginning of next month, you buy a little. To average into the market, for example, we said, if you haven't bought any gold or any oil or whatever, you don't throw all of your money into it immediately. You spread it over, let's say 6 months, and each month you buy 1/6 of it. All right? The idea is that you do not buy all at once because you might make a really bad entry point.
So, sir, that's what you're doing, sir, right? That's what you're doing, sir.
Yeah, essentially, that's what I've been doing myself. You know, as I get my income, I invest time. As I get my income, I invest time. So usually that's what you do. But you do steady accumulation. The idea is that you don't. In a steady accumulation is, in a sense, the exact opposite of market timing. What Jim Puplau is essentially saying, it is hard to time markets. It's extremely hard. You just can't time the market unless your name is Richard Russell, all right? So, if you're not Richard Russell, you'd better not time the market, because if you're not Richard Russell, you're likely going to time it wrong. Don't commit the mistake of timing the market wrong and surrendering lots of gains to the market. Just over the last 6 months, buy some. This is your average into your initial position. And then steady accumulation is every month or every 2 months you buy a little. Next month you buy a little.
But it doesn't confuse you that you buy this month and this price, and then another month with higher or lower price.
Yes, it does not bother you. So you bought, let's say, at 10. Next month is at 9. That's what it is. You average into the market. The next time you buy at 9, you're happy. You bought cheaper, all right? The next time it's the 8. You're happy. You bought cheaper. The next time you jump to 16. You're even happier because you already bought at 10, 9, and 8, and it's now 16. This means your investment is moving right. In other words, of course, with steady accumulation, you usually use some active investing. You usually use asset allocation, not necessarily. You usually use possibly defensive, possibly cyclical. You usually may buy with contrarian. And so, in other words, steady accumulation works really well with practically all investment strategies except one. No, except momentum. The idea with steady accumulation is that you don't, use the momentum. You just accumulate it. Where it's up, it's up. Where it's down, it's down. In a momentum, you try to catch the trend on the upside. And for example, steady accumulation is, Peter Schiff was explaining, 98, 99. Buying oil, buying gold. All right, maybe going up, maybe going down. He's accumulating oil. He's accumulating gold. This is what Richard Russell was also explaining. Steady accumulation in the late 90s and early 2001 is accumulating gold no matter what. Peter Schiff has been explaining the same about oil. He was buying oil in 99, 2000, 2001. You just buy a piece at a time. You don't try to time the market. Occasionally, he would use technical analysis. So steady accumulation, yes, it is also the exact opposite of market timing. But, for example, within my steady accumulation investment strategy, within the month, I'll try to time a little bit. I mean, I've used technical analysis for 15 years now, so I can afford the risk when I'm investing 2% of my portfolio, because my current investment is paying 2%, I can afford to time the market and to time it wrong. Alright? It is not a big deal when 2% of my portfolio is timed. What Jim Poplava is talking within averaging into the market, you're all into stocks and bonds and you say, oh my God, these are going down, I'm getting into gold. What he's saying is, don't sell the whole damn thing and don't buy gold today or on today. Sell some, switch into gold. Next month, sell some, switch into gold. In other words, make the transition smoother. The basic idea of steady accumulation is that timing the market is damn too hard unless you're a good professional. And 99% of market investors are not good at market timing. So you might as well, if you're an average investor, just accumulate steadily. It is a sure road to riches as long as you got the asset allocation right. And as long as you got some of the other things right, alright? The idea here is that you're watching oil going at 130, you don't sell it all, buy oil at 130, and then 6 months later, you lost half of your money, or 75% of your money, because oil went down 74% from 138 down to 38. And this could be morally, psychologically devastating to the point where oil goes down to 40, you sell in disgust, and you swear that you'll never buy oil again in your lifetime. Well, this is what most of the suckers actually did, right? This is, you know, how they define a sucker, right? Who buys at the top because he was watching the trend for too long, but didn't have the courage to invest, and then sells at the bottom in disgust because of fear. You know, he was the sucker because he didn't figure it out early to buy, and then he sold because he did not know why he bought in the first place. He bought because everyone else was buying, but everyone else wasn't buying. Everyone else already bought, and he was the last to buy. Alright? That's the difference. It's not everyone else is buying. Everyone else he saw already purchased. Alright? Is this good enough?
Yeah.
Alright, so, are you done? No. Alright, so, let me tell you about my house. In the US, 2000, about my house. And I'd like to tell this great contrarian story with Christmas. And with Christmas in the US, we get a whole bunch of Bulgarians. In 2002, a whole bunch of Bulgarians, like 40 Bulgarians, get on Christmas. This is our big holy, you know. Guess what Bulgarians are talking about? They get on Christmas Eve and talk about investing in real estate. They're investing in real estate, they're buying real estate, who's buying, who's looking, this and that. Every Bulgarian's into real estate. That's it. 40 people. Now, what is the characteristic, what's characterizing Bulgarians in US investing in real estate? Most of them are not sophisticated. They want the green card lottery. Alright? They're very unsophisticated investors. Most of them don't even have a university degree. Second, most of them don't have English. Don't know what's going on. They can't read on. They just see what others see. They kind of like, you know, doing it in a highly intuitive manner. Alright? So, yeah, they don't, you know, in other words, these are people that are non-investors, they're not sophisticated investors, they never, ever invested anything in their life. They never bought stock, bond, real estate, they never bought nothing. So, this as a collection represents the most unsophisticated of all investors. We got a name for it. These are the proverbial dumb money. Alright? So, next Christmas people are even more crazy. We get at 5 o'clock at the party. By 4 o'clock, a real estate bubble. So the next day I woke up and said, okay, I'm selling my house. That's it. You know. And I sold out. I sure sold out a little bit early, maybe 1, maybe 2 years early. Does it mean that because I sold out early that I lost money? No. Well, what did they all say? They said, how could you sell your house? We're all buying houses. Housing is the great investment in the whole world. There is, and you're investing in a house in the greatest country on the face of the earth, right? How could you go wrong behind? You know, this has got to be the stupidest decision ever. Everyone is buying a house and you're selling it. You know, what's wrong with this? Well, maybe nothing's wrong with me. Maybe because everyone is buying a house, that's the reason why I'm selling, alright? Well, so what did I do? I sold it all, I cashed out my equity, I had gained $20,000, $30,000, my house had gone up about 30-35%, almost 40% in 3 years. They bought in 2000 and put it all in gold and silver. Simple as that. So they all thought that I made a great error and a great mistake because I sold out, which means I lost so much money. But what they didn't see is that I lost so much money on the gains of the house, but actually made even more on gold. Because, you know, the house went up 10-15%, but my gold went up 25%, 30% on a non-leveraged basis, meaning on a lot lower risk. And I don't have the risk, you know, exposure, because housing market may freeze, as it did actually freeze, and all of them eventually got stuck. Now, how do I know it's a real estate bubble? We got this lovely Bulgarian friend and family. They're actually my friends. They're good friends of mine. They're just, you know, I'm actually very good friends with their daughter. You know, we studied together, we went through the PhD together. So, you know, if I'm 30 and their daughter is 30, they're close to 60. These guys are buying an expensive house in a very expensive neighborhood with a 30-year mortgage. They're 60 years old. They're about to retire or leave the country or whatever. 60 years old, buying a house with a 30-year mortgage, which is 4 times their income. They're making back then, jointly, the one is making $20,000, the other one is making $20,000. They buy a house for $140,000. I'm making back then $65,000, I'm going to buy a house for $75,000. Alright? So, you see how insane this whole thing is? Okay, this whole real estate market is totally insane. All we need to do is listen to the Richard Russell audio to know, okay, I'm out of it, and I don't need to be in it anymore. Is it good enough?
Yes.
Question?
Can you be too much of a contrarian?
Well, no, you can never be too much of a contrarian. You know, some contrarians trying to watch all contrarians, and then you're trying to be a contrarian to all contrarians. That may be a strategy, but that's not the idea. The idea is that we try to, you know, you can't be too much of a contrarian. What you can be, as many of those guys are, you know, for example, James guys, you can be, by being contrarian, could be extremely early in the market. So I sold too early my house. I sold it in 2003, way too early. But it was crystal clear that it was a bubble. You know, they were like saying, nobody saw the bubble coming, nobody saw the crisis coming. Well, I sold in 2003 and I sold in 2003. It's crystal clear. Peter Schiff been talking about it. Jim O'Donnell's been talking about it. All of these great guys have been talking about it. So the idea is that when you are a true, genuine contrarian, usually you're way, way, way too early. Sometimes you make a lot of premature trades. So you suffer from premature trade. For example, even when I came back in 2004 in Bulgaria, every guy is talking about investing in real estate. These guys are crazy about real estate. I wrote a nice great article about, you know, a great real estate bubble in Bulgaria in 2004. It was published on Christmas. They said that this was a curious, interesting, kind of like weird opinion that no one in Bulgaria would even agree. Why? We're getting into the European Union. This was the justification for the bubble. Alright? We're getting into the European Union. and the prices of Columbus, Ohio, never got to equal with the prices of New York. They're usually 3 times lower. They were 3 times lower 150 years ago. They were 3 times lower 100 years ago. They were 3 times lower 50 years ago. They were 3 times lower 3 years ago. They're now 3 times lower. And they will be 10, 20, 30 years, most likely 3 times lower. You know, just because you entered the greatest country in the world doesn't mean your real estate prices will equal that of New York or LA. No. Same thing with Europe. You know, just because you entered Europe doesn't mean that, you know, the prices in Sofia will equal that of Prague or Paris or whatnot. But this is how people justify bubbles. Alright? This was their justification. Now we're Europeans, right? Now we're doing everything like Europeans. We deserve European real estate. Well, it is. We bought dirt cheap, and our real estate price is going to go up 10 times. And of course, everyone was saying real estate prices will never fall. You know, a lot of people, as I told you, a lot of people felt really, really sorry for me because I had spent 15 years of my life studying finance and economics and investments, and I didn't learn the most important lesson in investing, which is real estate prices never fall. And of course, now we know real estate prices on the Black Sea crashed 40-50%, in the capital they crashed 30%. We're just warming up to the real estate, to the big real estate crash, because guess what? Real estate has crashed 30% in the whole country. No bank is going bankrupt. And currency board is holding up. Well, guess what's going to happen with real estate when 3 or 4 banks blow up, or when the currency board blows up? In other words, we haven't had yet financial crisis yet. What does it mean when we're going to get it? They should all talk about one thing, that the crisis is practically over and we're going to be on the road to recovery in a few months. Well, I wouldn't bet my money. I advise you, don't bet your money on it too. It's going to happen, of course.
Yeah.
Good to go.